Netflix reported earnings recently and it dropped close to 10%. Is it a buy or a trap? Let's look at why this stock is going down, then we'll look at the technical charts and then valuations to see if it's a buy. While Q1 was strong, Netflix issued a weaker than expected revenue forecast for the second quarter. Netflix reported an EPS of $23. However, a significant portion of that was driven by that one-time $2.8 billion termination fees. Also, their co-founder Reed Hastings leaving the board created some uncertainty. On the daily chart, it made a high and then higher low, but overall, it's still in a bearish trend. It was picking up momentum, but the earnings have not helped this stock. RSI was in overvalued territory, over 70, and now it has dropped back down. On the bottom indicator, it shows a big red bar. That means the institutional investors are selling. Moving on to the weekly chart, it has made a lower high and it doesn't have a clear direction. Stock was trying to cross above the 100 SMA, but it failed to do so. RSI is trending downwards. Let's look at the monthly chart. On the monthly chart, it's still in a long-term bullish trend, but if you look at the banker fund oscillator indicator, institutional investors are still selling. So in summary, on a daily chart it's bearish, the weekly chart doesn't have any direction, and it's a long-term bull trend in a monthly chart. Now let's look at the valuations. Stock has been traded at around 41 PE ratio in the past 5 years, but the adjusted earnings growth rate was only 22.37%. It carries 29% of debt, which is not bad for a growth stock. Total enterprise value is $427 billion. Analyst scorecard is not perfect for this company, and they have missed 18% of the time for the 1-year forecast, and that doubled in 2 years. Now let's look at the forecasting tool and see if it's a value buy. Let's check the normal PE ratio first. Normal PE ratio in this case has been 44 times. If it goes back to that level, then you are looking at over 30% of annualized rate of return. Going back to the estimates, analysts' estimates suggest growth is slowing going forward. Look at the flat line from 2026 to 2027, and then the growth will pick up slightly. FastGraphs gives it a fair value of 19.7 times. If that's true, then it will return a negative rate of return. Even if it trades at 25.5 PE ratio, you're still looking at about 7.4% return, which is not great in my opinion. It looks like the stock is still overvalued and not worth buying at this level. Let me know what your thoughts are on Netflix in the comment section. If you're buying this tip, say yes in the comments and don't forget to smash the like button. I'll see you next time.